Ladies and gentlemen, good day and welcome to Allcargo Gati Ltd Q1 FY’25 conference call hosted by Equirus Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jainam Shah from Equirus Securities. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on Allcargo Gati Ltd Q1 FY’25 earnings conference call. We have with us Mr. Firuzshah Sarkari, MD and CEO, and Mr. Anish Mathew, CFO. I hope everyone had a chance to view the financial results and investors presentation, which were recently posted on the company's website and stock exchanges. We will begin the call with the opening remarks from the management, followed by an open forum for Q&A. Before we begin, I would like to point out that this conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company, and it may involve risk and uncertainties that are difficult to predict. I now hand the conference over to Mr. Firuzshah Sarkari. Thank you, and over to you, sir.
Thank you, Mr. Shah. Good afternoon and a very warm welcome to everyone on our Q1 FY’25 earnings conference call. We have uploaded our results and earnings presentation on the stock exchange and company's website, and I hope everyone had an opportunity to go through the same. As mentioned, along with me, I have Mr. Anish Mathew, the Chief Financial Officer of Allcargo Gati Ltd, and our Investor Relations team. I will now share an overview of the economy, industry, and business, after which we'll hand over the call to Anish to discuss the financial performance of the company for the quarter ended June 24. I will now throw some light on the global and Indian economy. The International Monetary Fund, in its most recent update, has maintained its projection of global growth to be at 3.2% in 2024. It expects a marginal improvement in 2025 and projects the growth to be at 3.3%. While most risks to the shared outlook are balanced, some short-term risks like increase in prices of commodity and services due to renewed trade and geopolitical events still loom large. This has led to a persistent uncertainty around inflation outlook, which in turn has made central banks across major economies to stay more cautious about policy easing. Forecast for emerging markets has been revised upwards on the back of rebound in private consumption and increased exports. In order to maintain momentum for global growth, policy easing will have to be managed effectively. Projections for India continue to be buoyant. The IMF has raised its growth forecast for India to 7% for financial year 2025, while for financial year 2026 it remains unchanged at 6.5%. This upward revision in growth forecast is believed to be on the back of improving private consumption, especially in the rural areas. For financial year 23-24, average monthly GST collections stood at rupees 1.68 lakh crores. For the first 3 months, April, May, and June of the financial year 24-25, the GST collections stood at 2.1, 1.73, and 1.74 lakh crores respectively. This surge in GST collections reflects a positive economic trend for the country. Coming to the company, I would like to start by introducing the new Deputy Managing Director for Gati Express and Supply Chain Private Limited, Mr. Ketan Kulkarni. He was appointed as the Chief Growth Officer for Allcargo Group earlier this year and now has been elevated. Ketan comes with 3 decades of experience spanning across multiple sectors. His last stint was with Blue Dart Express, where he spent 17 years leading sustainable and strategic growth initiatives. With the induction of Ketan, we have further augmented our managerial strength. Another aspect that I would like to highlight is our cost optimization initiative. We have reported enhanced profitability at the gross and operating levels through streamlined cost optimization. I will now share some highlights on the growth pillars of the express business. On the technology front, I'm happy to share that we have launched the first module of our new technology. We have named it GATE, Gati Associate Tracking Engine. This monitors the movement of Gati associates, allowing real-time location and route sharing. This gives better visibility, thus enabling better customer service and better operating results. On the infrastructure front, we have successfully implemented phase 1 of the infrastructure update. And as already mentioned, we will continue with our journey to modernize the same in order to be future ready. We now have Ahmedabad, Kolkata and Pune, which we will start from this quarter. We will keep you posted on the development and timeline for each of those. On the sales acceleration, our efforts on sales initiatives have ensured consistent volume growth for the company. We are closely monitoring the customer churn. The sales team is working with data science team to analyze and improve customer connect by regulated connect. On the operations front, I would like to share our key performance indicators for the quarter ended June 2024. Our PIFOT, DIFOT and delivery efficiency stood at 90.5, 84.4 and 90.4% respectively. Other initiatives like timely and direct departures are continuously being monitored while taking corrective measures wherever needed. With this, I would like to hand over the call to Mr. Anish Mathew, our CFO, for financial highlights for quarter 4. For financial highlights for quarter 1 FY'25. Over to you, Anish.
Thank you, Phil. Good afternoon, everyone, and very warm welcome to our Q1 FY'25 earnings call. I'll take you through the highlights of financial results for the first quarter of financial year 2025. To start with, I'm happy to share that as on 30th June 2024, the company is debt-free with a net cash positive of 196 crores after a successful QIP of rupees 169 crores. I would like to start with the highlights of our express business first. Total tonnage handle for Q1 FY'25 stood at 300,000 metric tons as compared to 306,000 tons for Q4 FY'24 and 292,000 tons for Q1 FY'24. Revenue from express business stood at rupees 358 crores as compared to rupees 355 crores for Q4 FY'24 and rupees 367 crores for Q1 FY'24. Corresponding gross margin has improved by 100 basis points and stands at 27% for Q1 FY'25 as compared to 26% for the quarter ended March 2024. EBITDA for the express business stood at rupees 20 crores in Q1 FY'25 as against rupees 15 crores in Q4 FY'24, representing a growth of 33%. Our sustained efforts on cost optimization has translated into this growth in EBITDA. The endeavor is to continue with our efforts going forward as well and look to maximize profitability. Client mix for the quarter ended June 2024 for KEA, SME and retail stood at 63%, 19% and 18% respectively. On a consolidated basis, the company has reported a revenue of rupees 408 crores for Q1 FY'25 as against 406 crores in the previous quarter and rupees 426 crores during the same quarter last year. EBITDA margin for Q1 FY'25 stood at 5% as against 3% during Q4 24 and 4% in Q1 FY'24. With this, I would like to open the floor for question and answers.
very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Rushabh from RBSA Investment Managers. Please go ahead.
Yeah, hi, sir. So we have seen a 1% improvement in gross margins for the first quarter and quarter. So is it reasonable to expect that we, by the end of, say, FY'25, we're able to, improve gross margins 1% every quarter, given the cost reduction initiative that we're targeting in this year?
So as I said in my last quarter also, we have clearly identified that the gross margin expansion will happen mainly through cost reduction. We are already on that path. We have substantially reduced our operating cost as well as our S&OP, and we will continue to do that. We are also looking at changing the mix of our large customers to our SME and retail. We have managed to make a change, and we'll further make a change. And the combination of these will definitely get us the expansion quarter by quarter on our gross margin.
So what would be the aspirational customer mix between key accounts and MSME retail, say, 2 years down the line?
So our first benchmark is to bring 60-40, and then the aspirational is 55-45.
And so what's the traction now currently, post the strategy change that we did in January after hiring Mr. Uday Sharma? What is it, if you could share some broader strategy in terms of adding new franchisees or associates? How is the traction there, and what is the payback period for the new franchises that we are adding?
So our business model is basically to keep growing our network, both from a service as well as from a penetration of customers in the tier 1 cities. And as and when we get substantial volume, we open up a franchise so that it will enable us to service the customer well, and in turn the franchise also starts selling. The return on investment is by both methodologies. One is by servicing the customer and therefore enhancing the business from various customers to that PIN code of new service, as well as then looking at creating some business around that code. It differs from PIN code to PIN code. There is no one real return on investment, but the fact that we open up a franchisee means that we have substantial volume that can get delivered there.
So we have been hovering around the 300, the 3 lakh metric tons in the volume range. So for FY'25, is it reasonable to expect that we grow at least 12 to 13% volumes in this year and the year after that as well?
No, so we have put out that in this year we would be looking at anywhere around 15% growth. We have now set our sales as well as operations, and therefore with season coming up this quarter, we are looking at ramping up the growth. And then for the next couple of quarters, it should be plus of 15-16%.
Next couple of years, you mean, or quarters?
Years.
Okay. And sir, we had a target of, revenue of 3,000 crores by FY'26 with 10 to 12% margin. So where does it stand today? Since now we're also having a, management change, how do you look at the company now?
So we will continue to grow this business. The profitability is very clearly the first target for us to get. Like I have said, we are looking at getting us to the 30+% gross margin and 10+% EBITDA, and we strongly believe that we should achieve this by 26-27.
And this 3,000 crore target and this margin, is it without the all contract logistics business?
It is
merger
with
will happen by
contract. It is with the contract logistics business.
It is with, okay.
Yes.
Because I assume that the contract logistics is a very high margin, say 35% margin plus. So, achieving 10-12% should not be a challenge on a console basis.
Correct. The only thing is it's a small business just now. So the proportion of the business is small compared to the express business.
Okay. Because years, in the say 4 to 5 years, the pre-India's margins that those guys are targeting is 14-15%. So in the long term, that should be the aspiration, right?
Yes, correct.
Okay, sir. Thank you. I'll just join back with you, sir.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask questions. Our next question is from the line of Jainam Shah from Equirus Securities. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. So my question is to the corporate restructuring pass first. So how we are going ahead with that particular plan? By when it is expected to have the another entity like Allcargo Logistics and Allcargo Gati Ltd. Is this on time by December this year?
So we have filed with the stock exchanges who have given their approval, and the file is with SEBI. Post that, it will go to the NCLT. So we believe that latest by first quarter of next year, we should get the merger done.
Okay, sir. Okay, got it. And sir, on the operational part, as you have said that there has been a expansion in the gross margin this particular quarter. However, how is the overall industry volume going on? Are we seeing any slowdown in the overall industry volume, or is this just this quarter impact because of election? And if we see from next 2 to 3 years perspective, how our express business is expected to pan out as compared to the overall market growth?
So I think if I were to answer your second question first, express logistics has a very, very large role to play once manufacturing comes into the country in a big way. A lot of the manufacturers who want to make it large would want inventories on wheel for their finished products and not really store them for a long period of time. So from that perspective, we believe that express logistics is going to play a very important role, and therefore the growth of express logistics should be, as manufacturing happens, should be exponentially large in this country. Coming to the first quarter, yes, there were a couple of things. One is, of course, the election. Second is, we did have some natural calamities in certain parts of the country, and therefore volumes were subdued. But this quarter, July, August, September, as you know, is supposed to be one of the largest quarters for the pre-festivities inventory, and therefore we should see a very good second quarter.
Got it, sir. If I have anything, I will join with you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask questions. Our next question is from the line of Rushabh from RBSA Investment Manager. Please go ahead.
Hello? Yes, sir. So what you've been hearing in the market is one of the large players has been reducing prices to gain entry with new customers. So what is the assessment as far as the yield is concerned for the company? Have the yield stabilized, and also we are targeting a targeted intra versus interstate mix. So that has been corrected so far?
So like I've been saying before, as far as is concerned, the way we will improve our yield is by improving our mix and not by going to the customers to increase price. Because we know that in India, logistics costs are still extremely high. And therefore, it is important for us to first optimize the costs rather than asking customers to pay more. We believe that the mix between zonal and the national play is continuously improving, and that will not affect really the yield, but the gross margins should get better because the costs, direct costs, are far lower in the case of zonal play rather than national play.
And so we have recently done a fundraiser of around 160-170 crores. Does this, cater to a growth strategy for the next 2-3 years? Well, we would not like to do fundraise another in the near term at least.
So we have done this for the growth strategy. As you know, the group has now got 4 separate listed entities, and each entity has its own management MD and should have its own funds. And therefore, we did a QIP by which we now have growth capital for ourselves, which we will invest in infrastructure, in technology, as well as other processes which we require. So yes, to answer your question, we have money for the next growth.
And so we won't be requiring fundraising at least for the next 3 to 4 years. Is that what the understanding is?
So fundraising depends on the circumstance, right? It's not something that one can say no at all to. It all depends on what is the opportunity, where is the opportunity, and what is the fund requirement. So I cannot say no to that right now.
Okay. And so we said that we're targeting a direct cost reduction of 5% in FY'25. But if I look at, say, FY'26, so there will be more opportunities to reduce cost. So this is not the dead end for us for our cost reduction initiatives.
Sorry, I did not get your question.
I'm just saying, like, we have targeted a cost reduction of 5% in FY'25 in terms of direct cost. So when I look at FY'26, there will be more initiatives to reduce cost as far as the company is concerned.
Yes, absolutely. So as you know, in our express logistics industry, the more the volume, the better the cost, because the unit economics changes, right? So as we start increasing our volumes, the ability for us to reduce our cost per kg increases also. So definitely it will be a continuous process and not one-off only in 25.
And so is it to say, so from onwards, since a lot of groundwork has happened now since when the Allcargo Group took over, in the next 3 to 5 years, can Gati be the sustainably be the number 2 player in the B2B express space, and all efforts are towards that, achieving that?
Absolutely. So clearly, we will measure ourselves by the growth that we do quarter over quarter, and that has to be beating the market growth. Only then can we become market leaders, and the group itself stands for market leadership. So that's the way we are driving our teams.
And so we have mentioned about employee headcount rationalization time and again. So is that exercise completely over, or can we see some benefits on that front as well?
No, as technology rolls in, we will see more benefits on that end.
Okay. So is there any timelines? Because you mentioned that first module has been launched. As and when the modules keep launching, how much benefit can we see in the P&L?
So I had last time also said that we have a very large compared to competition. If you see our below gross margin S&OP for employee cost, it is as a percentage of sales larger than competition. This is basically because our technology is very old. So as the new technology rolls out, we have an opportunity to reduce a large number of people from our S&OP cost.
And sir, currently in all the key accounts that we're currently catering, would we be in the top 3 or top 2 vendors for most of our existing customers, or there is still scope for improvement in existing key accounts as well?
There is tremendous scope for improving our wallet share with the customer. Today, on an average, our wallet share is about 30% with the large customers. So we still have a good opportunity to increase our wallet share.
And just to understand, what will be the minimum and maximum revenue of our key account customers? Just to understand the customer, what classification comes in the key accounts? Is there a metric that you can share?
So the way we have set it up now is that all customers who are above 20 lakh of revenue annual are in key accounts or large accounts.
Okay. So thank you so much, sir. Wishing you all the best.
Thank you.
Thank you. Our next question is from the line of Sukriti from Librum Capital. Please go ahead.
Hi, sir. This is Sukriti from Librum Capital. I have one question. I believe a lot of the B2C e-com players are adding PTL Express as a vertical. We saw delivery do that with Spot On a few years ago, but a bunch of others seem to be adding B2B Express as a vertical to better utilize the same B2C line. And the logic there is that it gives us a cost advantage on both the PTL Express as well as the B2C side. Are you seeing the space, at least the organized space, becoming a lot more competitive, given that there are a number of new players in B2B Express from the B2C side versus, let's say, 4-5 years ago?
So thank you for asking this question. The number of players that you're talking about, according to me, is just 2. First of all, I don't know more than 2 players. Having said that, B2B networks are very different from B2C networks, and it becomes extremely difficult if somebody has to start a B2B network today and make it a pan-India play. So while people have definitely realized that B2B is a more profitable business than B2C and therefore want to include B2B in their network, I think there is a huge barrier to entry for those who do not have an existing network.
So just to push back on this, Phil, see, the B2C network would be much larger. In my, as I understand, the B2B network would cover less number of PIN codes as opposed to a B2C network. So if you already have a B2C network and you want to piggyback a B2B network on top of that, aren't you just catering to a subset of your current PIN codes, and you're not really building out something you're not expanding on your current network?
So if you look at the loads that move in a B2C network, to cater to those loads, the kind of network that you build out and the last mile that you build out is very different than the network that you build out for B2B. A B2C truck today, a 30-footer truck carries anywhere between 3 to 4 tons of material. And therefore, on the other side, you are catering to 3 to 4 tons of material, whereas a B2B truck carries 10 to 11 tons of material in the same truck. And if you were to say that the network of a B2C can be used for B2B, that will be a disaster, because the cost that you will incur to deliver B2B in a B2C network will be tremendous, because B2B requires 4-wheeler capacity utilization, whereas B2C is mainly done on a 2-wheeler.
Got it. Got it. So there are no synergies, as per what you're saying. This is a little different from what you would typically hear in a delivery call, though.
It is very different.
Got it. Got it. Thanks a lot. Thanks a lot.
Thank you. A reminder to all participants, you may press star and one to ask questions. Our next question is from the line of Jaimin Shah. Please go ahead, sir.
Yeah. Hi, sir. Thanks for the opportunity again. So this question relates to the acquisition by the Allcargo. So basically, if we see 4 to 5 years back, Allcargo has acquired the Gati, and there has been a clear path how to make it profitable going forward. As we are in between of that particular path, how we are seeing next 3 to 5 years turning out to be for the Gati? And other question will be on the contract logistics business. As once a small portion of the GSCPL of contract logistics and also for the Allcargo supply chain comes together, how we are working on that particular business growth?
So thank you for asking this question. It's been now almost 4 years that Allcargo acquired Gati. And while a lot of work has been done and we have literally cleaned up the balance sheet now, if you look at the balance sheet of Allcargo Gati, I think we are at an inflection point as far as the operations and sales is concerned. And the next 2 years will see growth and profitability in this organization. As far as contract logistics is concerned, it was a niche business that got acquired again by Allcargo. And then post-acquisition, we expanded that business into non-chemical. So when we acquired the business, it was only a chemical warehousing company. And then we have now expanded it into areas of e-commerce, automotive, and engineering. And I think it has been a phenomenal growth story in the contract logistics business. Although small, we are looking at this business growing at a CAGR of 30% in the next 3 years, because the opportunity that is available in the market is huge. So basically, the reason why we have a scheme out there for merging these two businesses is because we believe that as manufacturing comes into the country, we will need a fulfillment logistics, and these large manufacturers will need one-point service providers who can give them both warehousing and distribution.
Got it, sir. And sir, if you look from the market share angle, of course, there has been, if we see last 4 to 5 quarters, the growth has been muted across the industry major players. What could be the steps that we will be taking to gain mega market share that was there maybe 7, 8 years back? And maybe some infrastructure, maybe IT system that was not in place, now coming in place. Is it going to help us in market share gain as well with the improving efficiency, data, delivery timeline and all those things?
Oh, absolutely. So that is why what we have shown as growth for the next 2-3 years is more than the industry growth. That's how we intend to increase our market share. We believe that we have got one of the deepest networks in the country, and most of the growth will come from the tier 1, tier 2 cities in this country, and that's where a network that Gati has will be able to capitalize upon that growth.
Got it, sir. Sir, just contrast to what other companies were telling or they're reporting, there has been stress in their margins and few of the cost structure for those companies are increasing. By any chance, if we able to have the better margins as compared to the past, but because of the cost pressure at the industrial level, we might have some, we might lose some margins against what we have expected?
No, on the contrary, at Gati, we are concentrating on clearly quarter-over-quarter optimizing our costs. And we believe that there is huge opportunity for us to do so. And therefore, if yields being constant, if we can optimize our costs, our margins have to expand. Having said that, we also believe that a good mix of the SME and retail customer going up, as we have shown in this quarter over last quarter, that will also contribute to better gross margins and therefore better EBITDAs for the organization.
Got it, sir. On this SME part, as I would say that always there has been a branding that might attract the SME customers. So after the corporate restructuring, our name would be Allcargo Logistics. So what could be our plan? Are we going ahead with the Gati brand, or we would be having Allcargo's brand only going forward, maybe after 1 year or something, or how we would be rebranding entire business for specifically for the SME customers to gain their attractions?
So our brand already is now Allcargo Gati. It is neither only Allcargo nor Gati. It is Allcargo Gati. So we have the benefits of both one of the industry leaders at one time, Gati, and the current industry leader, Allcargo, putting together the brand is Allcargo Gati. And I think with the induction of Ketan, who has been spearheading marketing for Blue Dart for the last more than a decade, we will see a lot more marketing happening out of the Allcargo Gati arena.
Got it, sir. That's it from my side.
Thank you
so much, sir.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask questions. Our next question is from the line of Gautam from Mayuran Capital. Please go ahead.
Hi, thanks for taking my question. Just a small clarification on what you mentioned earlier on the EBITDA margin. You said the EBITDA margin guidance includes the contract logistics, and that would still make it 10%. Now, I assume you are talking about 10% pre-Ind AS, right? Because at the moment, on my numbers, at least from what I was saying, in FY'24, pro forma for your merger with contract logistics, you are already at 10% pre-Ind AS EBITDA margin. So what you're saying is 10% pre-Ind AS, not post-Ind AS.
I'm saying pre-Ind AS.
Okay. So that means a substantial margin improvement from today's levels.
Yes.
Something like 5 to 6%.
Like I said, we have a contract logistics business which is still substantially smaller than our express logistics business. So as we grow that, and we are very positive about that business growth, doing a CAGR of 30% over the next 2-3 years, that should give us a good margin for our businesses put together. And of course, we keep improving our express margins also.
No, it's just, this is an important point because contract logistics being a 40% EBITDA margin business post-Ind AS, but pre-Ind AS it's only about 12%. So on a combined basis, you're talking about a pre-Ind AS number.
Yes.
Perfect. Thank you, sir. Thank you.
Thank you. Our next question is from the line of Ronald from Sharekhan Limited. Please go ahead.
Yeah, good afternoon, sir, and thank you for giving me the opportunity. The first question is, are we done with the, old legacy issues with respect to key accounts? Because as going ahead also, you will be rationalizing a few accounts to improve the mix. So should there be a stability, or can there be 1 or 2 quarters where, these issues, old legacy issues can come forward?
So I can only say that 99% is over. I cannot say 100%, but yes, old legacies are over. You've seen the ECLM provisions reduced in the last 4 quarters from what it was 4 quarters back. That in itself gives the confidence that most of the old legacy issues are now over.
Great, sir. And secondly, on you, if you can tell us what about the capex numbers, what you are expected to do over the next 2 to 3 years in terms of CapEx, and the funds which would be utilized, the funds, how they would be utilized going ahead?
So we have set aside very clearly when we did our QIP also 30 crores for technology and another 40 crores for infrastructure, which means the size of the new hubs that we lease out as we move forward. And that basically is the capex investment that we would look at on the Allcargo Gati side of the business.
Okay. And this would be over the next 2 years, right?
2 years, yes.
Okay. Thank you very much, and best of luck.
Thank you. A reminder to all participants, please press star and 1 to ask question. Our next question is from the line of Jainam Shah. Please go ahead, sir.
Yeah, thank you for the opportunity again. So this question relates to the amalgamation that we would be having with contract logistics and our B2B express business. So if we see your competitors as well, that there would be an added advantage to have a transportation as well as warehousing business under one umbrella. So how we are building on to the additional revenue we might get with these two businesses coming together?
So first of all, even today, as you know, the number of customers in express logistics is far, far more than the number of customers in contract logistics. So one is cross sales, which is basically taking the contract logistics customers to the express customers who have the need for contract logistics. Number two is applying for the RFQs for both warehousing and distribution together and giving a single unit price to the customer so that the customer clearly understands that there is a price per order for them rather than a separate price for warehousing and a separate price for distribution. And I think that is what the customer would be looking forward to, so that they know exactly the cost of fulfilling an order from their side. So we believe that it will also make our express business more sticky than what it is today, because contract logistics generally gives you a longer term.
Got it, sir. Got it. And so, yeah.
Sorry?
Yeah, please, sir, go ahead.
Can you hear me?
Yes, sir. Yes, sir. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask questions. Our next question is from the line of Madhur Rathi from Counter Cycling Investments. Please go ahead.
Sir, thank you for the opportunity. Sir, I wanted to understand, I'm a little bit new to the company. Sir, why has our revenue been stagnant for the past 5 to 6 quarters? And similarly, our volume, so you have guided that a 15% volume growth we can expect for this year, but why were they flat for the next previous 5 to 6 quarters?
If you look at our volume, we have grown the last year by 9% in our volume. It's not been flat. Basically, there is a volume growth, and we'll continue to grow our volume as our infrastructure and our service improve. So that's one data point that I'd like to register. The other is, of course, now with the new focused sales team under the Chief Commercial Officer, Uday Sharma, who has joined the last 3-4 months from Spot On Delivery. We believe that we'll get a impetus to the growth that we already had in the last 1 year.
Okay. And sir, what kind of realization or the yield increase can we see from the shift from the larger clients to SME and retail?
I
Hello?
did not get your question. Can you repeat it, please?
Yes. Sir, what kind of yield or realization per ton increase can we see from the shift from larger customers to the SME and the retail customers for FY'25 as well as the next year?
So, we are looking forward, right? We are hovering at an overall yield of about 11.8. We look forward to increasing it by 10 paise year for the next 2 years by changing the mix.
Okay. So that's it. That was from my side. Thank you so much and all the best.
Thank you. Our next question is from the line of Ravi Mehta from OneUp. Please go ahead.
Yeah. So just to, I couldn't catch the number you just said earlier, and then I'll just come to my question.
I was saying that we are looking at increasing our yield by 10 paise year on year by changing the mix of large customer to small and retail customers.
Okay. And my question was actually pertaining to the mix. So we saw a mix change in this Q1 on a sequential basis, but it was very similar on YOY basis. So is this a seasonality element and the key account mix will again go up in the coming quarters, or this is a structural one? I just wanted some color on this.
So like I had said in my last quarter, post the induction of our Chief Commercial Officer, we have been concentrating on an inside sale for the small MSME customers. While we have not completely still done the inside sales setup, it has started in the first quarter, and we're very buoyant on the change that will come about because of that. So we'll continue to focus on inside sales to attract the smaller customers for us.
Okay. So broadly, the mix you think would be similar to Q1 or maybe a little bit may still skew towards key accounts in this year?
So we would be looking at ending the year with a mix of about 60-40.
Okay. Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Prayesh Shah Sarkari for closing comments.
So thank you, everyone. If you have any further questions, please do get back to our investor relations team, and we look forward to meeting you all in the next quarter. Thank you very much.
Thank you. On behalf of Equirus Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.